welcome to our first time homebuyer seminar. I am so happy and I appreciate everyone that came over today that made the effort. Thank you. I'm going to do the introduction. This is Julie Title. She is the senior mortgage loan officer that I have partnered up with to make this beautiful event for everyone. My name is Christiane G. Perez. I'm a licensed real estate agent with Highline Residential. And we have a special guest, Francis. He is my real estate partner and we are all in the same company. And then we have our information here, so if you guys want to write it down in the future, whenever you guys are ready to get a home loan, you would speak to me and Julie and Francis and we'll make sure to help you all, okay? So let me go over to the next one. So I'm going to go over the topics that we're gonna go over today. This is a first time homebuyer seminar, so what our goal is to walk you through the steps from A to Z and to make it as simple as possible. And the goal here today is for you guys to leave with the knowledge, the confidence, and exactly what to know. So when you're ready to buy a home in the future, whenever that is, you are set and ready to go. Okay, so we're going to be discussing mortgage terms for you to know. We're going to look at what lenders consider when pre-approving you from a lender herself, and different loans and what can benefit you. We're going to talk a little bit about down payment assistance programs, who qualifies, who doesn't, and we're going to have an open discussion at the end. Okay, so I'm going to let Julie take over, and I will be here if you guys have any questions. Like I said, let's leave it for the end. Take it away, Julie.
Okay. So I'm Julie Title. I work at Citizens Bank. As far as getting pre-qualified, well, the most important thing is to get pre-approved by a mortgage lender. So I'm going to sort of go through the 4 things I look at as a mortgage banker when I am pre-qualifying you as the client. The number 1 thing is income. And when I look at income, my bank and every bank, we have something called debt to income ratio. And that is called the DTI. And when we talk to underwriters, or when I'm pitching a loan to an underwriter, my debt to income ratio has to be a certain percentage. So it's usually 43%. Now, how do I figure out somebody's debt to income ratio? Very simple. I figure out all your debt, and we're going to divide it by your income. Income should be easy if somebody is on salary. So if your salary, let's say, is $10,000 a month, we take that gross number as a W-2 salaried employee. Very simple. That will be the number we use, is that $10,000 gross income that you make. Now, if someone's self-employed, if you are self-employed, most important is to make sure you get pre-approved immediately. The bank is going to ask for your tax returns. If you're a Schedule C or 1099, we'll just get your 1040 tax returns. If you have corporate returns, I'll need the corporate returns. I'll need K-1s, and I'm going to need this for the last 2 years. We are going to use net income. Opposed to a salary person, we're using gross. But if you're self-employed, we're using net, and we're averaging for 2 years. Then we take that number and we divide it by 12, and that is the income for the debt to income / DTI. How we figure out the debt, I'm going to take whatever the monthly mortgage is going to be, plus the monthly insurance, plus the monthly taxes. If it's a condo, I'm going to add in the monthly HOA, and then I'm going to take all your other monthly debt. So I'm only going to take this debt off of what I see on a credit report, or I shouldn't say that. If you have a mortgage or if you have a credit card that's not showing on the credit report, I will also take that. We're going to take the minimum amount due every month. If you have a student loan, I'm going to use the minimum amount due every month. I'm going to add that again with what we call PITI. We're just taking the mortgage, the tax, the common charges, and all your monthly debt on the credit report. So minimum credit card payment, minimum student loans. If you own any other property, we are going to take all that pity as well. So all the monthly mortgage, tax, insurance, and HOA. We add it up, and very simply, we divide it by whatever your income is. So as a first-time home buyer, it's imperative to speak to a mortgage specialist and get pre-approved. It should always be free. You should never have to pay to get pre-approved, and that's really important to note. Even nowadays, it's very simple. I send a link out. You fill out the link. We run your credit. In order to get an appropriate pre-approval letter that most sellers are going to take these days, we must have a credit score. So I'm going to move into my other item I'm looking at, which is credit. Very simple. And I'm going to tell you that if you don't want to get pre-approved and you don't feel like talking to a mortgage banker quite yet, and let's say you need to look at your credit, you're worried that something happened and you're not sure of your credit score, never ever go to a free credit company. Credit Karma is completely not accurate and has gotten myself and many people into too many problems because you think your credit score is good. And of course, Credit Karma is always going to give you a better score. These free credit bureaus, the free credit reports are not good. They not accurate. And, as a mortgage banker, my guidelines are strict with, loan. Well, I'm going to get to loan to value, but everything is based upon a credit score. Your rate, your loan amount that we're getting you, everything. So I would say a safe place to find your credit score if you don't want to get pre-approved by a bank is www.myfico.com. And we don't have it up here, but you can contact one of us and we will get you the website. People get worried about running their credit. Here's another thing. I always get this question. Is it okay to run my credit? I heard it lowers my credit score. If you run your credit, they say within 2 weeks, it should not lower your score. If you want to check it out and you don't want a bank to pre-approve you yet, if you go to www.myfico.com, it will not hurt your score. Super accurate. I think it's $40. So 740 and above, a credit score 740 and above, you will get the best rate. Fannie Mae basically goes down to 620 these days. FHA, you can go into the 500 range. Personally, I would say you'd want to be between 700 and 740 with a credit score. If you have issues with your credit, you just need time. There are ways to help your credit. I have people I can put you in touch with that can help fix the credit score. Sometimes it's as easy as making sure that your credit cards aren't maxed out. And there's several ways to get your credit score where it needs to be. And it's very, very important to get this done before you go looking for a home. Make sure that your credit score is where it needs to be. Another really important thing that you need to know is that you're supposed to have 4 lines of credit. So especially with people that are new to the country, I have this very often. Most countries are not so excited about debt the way we are in America. And they come and they have 1 to 2 credit lines. Pay it on time all the time. And unfortunately, it hurts their credit score. Also, there are a lot of programs where you just need to have 4 credit lines. So that's very, very important. And for 12 months, shown that it's paid on time. So something that might be helpful is just go to Bloomingdale's or somewhere easy to get a credit card and use it a little bit and make sure you pay it off on time. Assets. Okay, so 1 is income, 2 is credit, 3 is assets. It should be relatively simple. Assets, you need your down payment to close. You need whatever it's going to be, and we're going to go through that in a moment. There's another term that you will hear. It's called LTV, loan to value. So, simple. If your loan amount is 900,000 and your value or your purchase price is $1 million, you take loan amount, divide by value, loan to value. So 900 loan on $1 million value is an LTV of 90%. That said, when you're talking assets, it should be relatively easy. The client, you as the buyer, should have your down payment, your 10%, plus your closing costs, which we will go into in a moment, and then a little bit of a reserve. What is a reserve is your monthly pity. So your mortgage payment, your tax, your insurance, your HOA, times either whatever the guideline would be for that product. Fannie Mae's 2 months pity, some other products are 12 months pity. Sometimes if you need a big exception, it's 24 months pity. So if your mortgage payment with your taxes and your insurance and everything included is $2,500, you may need $5,000 in reserves, depending on the program. So you need your down payment, you need your closing costs, and you need your reserves. Why? You can't go to closing and wipe out everything and have a zero in your bank account. Because God forbid you lose your job next month, we know you could have a problem. Okay, so assets, another thing is, people, I say to them, where's your money coming from? It can't be cash, absolute no. It can't come from a mattress, it can't come from a friend. It has to be, if a gift, it's supposed to be a family member or relative. When it's coming from overseas, it's got to be verified. We are tracking everything for 2 months. We will go back 2 months into bank statements. So if you're bringing money from overseas, I have to get it translated to dollars. I have to get it translated to English. And then I have to verify money in and out and get that translated. It can cost a lot of money. It could be timely. So what I'm going to say as a first-time home buyer or as any buyer, make sure that all your money is brought into your bank account, if possible, 2 months before you apply for a mortgage. So if you lent money to a friend, please, I tell you, I will track that money back years and years ago. If you won it at a casino, I've had to literally go to the casino and track money. So everything needs to hopefully be in 2 months before you apply for a mortgage, if possible.
So we're going to talk about now the different kinds of mortgage loans. And in this segment, you guys can pretty much figure out what would work best for you. And we're going to talk about a little bit of down payment assistance and closing costs.
Right, okay. So we have several options, and I don't want to go into every single little detail of who would apply for which option. I think it's easy, generally speaking, just to see that we have a program called DHM, that's my portfolio product, Home Ready, Sony May, Sony May's for first-time home buyers. They're all, some of them are combined with first-time home buying and census track. So depending on where the property is, it might hit something called low to moderate income census track. That combined with income, depending on the census track and the zip code, you cannot make past a certain amount of income. And I have a chart. I can, again, if you contact either one of us, I can send the chart to you. Or if you contact me, what I can do is take your information. I can figure out what income track it fits within. And then each program will have a certain loan to value, like I said before. So if I have somebody call me and they only want to put down 3%, so that would be 97% financing, but yet their credit score is 660. And they have a certain income and they meet the income limits, but they're not in a track, it might hit one of these programs and not the other. So, not to confuse anyone, but there's different programs for each person's income, their track, their credit score, and the amount they want to put down. The good news is that it's very lenient, and if you don't have a lot to put down and your credit score has not yet gotten to a spot where it needs to be, there are several programs for you, combined with being a first-time home buyer. And I have, if you contact me, I have a separate breakdown of each program. So the other thing is that these programs offer assistance for your closing costs. And depending, again, on your county, the CCA has just increased from $7,500 to $10,000 in Kings County, New York County, and Queens County. And we can give as much as $15,000 in closing costs assistance. It's repayable over 10 years and forgivable after 10 years. I'm sorry, it's forgivable after 10 years. So what could happen is in certain situations, let's say we're offering a 6.5 rate without closing cost assistance, and then you could also choose an option of 6.75 with the closing cost assistance. If for some reason you don't fit within one of these programs, I am very creative and also can help figure out ways to give a different interest rate and then maybe give closing cost credit so that I can help with your closing costs. So I'm going to move on to closing costs, and I'm going to be slightly brief about closing costs, and I'm going to start with, actually I'm going to run through closing costs. Every bank has a junk fee. It's going to be labeled as, they won't call it a junk fee, they'll call it application, underwriting fee, or processing fee. And my fee is $9.95. Most banks, most brokers are around, I'd say, $1,100 to $1,500. And that is a junk fee. And that's how it's going to be labeled. When you apply for a loan, you're going to get something called a closing disclosure. And that disclosure is going to throw in every single closing cost I mentioned, whether or not you actually have to pay it. So it can be super confusing, which is why you need a good mortgage banker to explain each thing on the closing disclosure and explain what you actually are going to have to pay and what they're saying you would maybe have to pay. And then I'm going to then circle back with your attorney, and your attorney will usually go through the closing costs as well. So it can get confusing because the attorney in New York will order title, and the title is going to be labeled and the taxes are going to be labeled on the bank's closing disclosure, and most likely your attorney is going to go over the same costs. And so what I do is I give a synopsis. But just note that there's title charges that the attorney orders the title usually, unless it's a refinance. In New York, if the loan amount is, in New York, in the 5 boroughs, we have a state mortgage tax, which is about 1.9%. We have a mansion tax of about 1%. It's a sliding scale if the purchase price is over $1 million. The seller's transfer tax is generally paid for by the seller and not the buyer, but you might see it on your closing disclosure. And again, will be explained to you that your contract of sale and your attorney will confirm that you're most likely not paying that. Only in about 1% of the cases will the buyer pay the transfer tax or the seller's tax. And so that is something to look out for and make sure that that's not in your contract. And generally speaking, the only time you'll see a buyer paying this transfer tax or the seller's tax is in new conversions and new condos. It's standard and customary that you're paying the seller's taxes and the seller's attorney. Otherwise, it's not customary. There's going to be something like a flood cert fee that should be around $15. Credit report fee around $25. The appraisal fee, that should really be the only upfront fee, and that is a sliding scale depending on the purchase price, somewhere around $500, $600. There's interest per diem. That is the same thing as your mortgage payment. So if you close on the last day of the month, that technically is zero. If you were to close on December 15th, then you owe the interest per diem, the interest per day for the last 15 days of December. But mortgages get paid in the arrears. So if you were to close on December 15th, you pay those 15 days, you get to skip January, and your first mortgage payment's not till February. Then there's a bank attorney fee. That should be around $1,000, give or take. And that's on top of, in New York, your attorney fee. Also, there is something called escrows. It can be a little confusing. So escrows, by the way, can be waived for free in New York, depending on the situation, not always for first-time home buyers. What an escrow is that the bank likes to collect and pay your taxes and your insurance for you. Because if for some reason you were to miss your insurance payment and something would happen to the property, the bank has no collateral. If you miss your real estate taxes and you're behind 6 months, guess who gets first position? It's not the bank. And that's the reason that banks escrow taxes and insurance. And how it works is at the closing, we're going to collect a cushion, 2 to 6 months of taxes and insurance. That cushion will sit in an escrow account, and it does gain a little bit of interest. Then every month when you pay your mortgage, you're paying your mortgage plus your insurance and your taxes to your lender. Your lender then pays the insurance and the taxes for you. Generally, after a year, if you're paying on time and you don't want to do this anymore, you can call servicing and ask if they can look at the account and release your escrows. This is not real money that you're paying because it's sitting in an account and you will always get it back when you pay off your mortgage. And then I just want to backtrack to when you're applying for a mortgage, the documents that the mortgage lender will need. Generally, we run the whole application through something called Desktop Underwriter. And the Desktop Underwriter will give me a list of what's needed. So it could be streamlined, depending if that Desktop Underwriter likes the file. I might not need what I'm going to tell you I need. But generally, if you're looking to buy, you should know that you're going to need to collect 1 month of pay stubs if you are salaried. If you are self-employed, I will need your last 2 years, like I mentioned before, personal returns, corporate returns. By the way, self-employment to a bank means that anytime you own any business over 25%, I am going to need those K-1s, the corporate returns, and that could be a situation where, like, if you have a partner that's 75% owner, you need to know that you're still going to have to get those corporate returns. If you are salaried, 1 month pay stubs, 2 years W-2s, 2 months bank statements, all pages, any large deposit I'm going to ask you about. So be prepared to be grilled. Any large deposit. Now what they're doing as well is when they see money coming out of the bank statement, which they never did, they'll ask me what it is. So, I mean, I've had situations where we've asked a client and she said it was her therapist. But unfortunately, well, not unfortunately, just be prepared. We are going to possibly ask you for everything. If you own other property, you'll need to get all the tax bills, all the insurance bills, all the mortgage statements. Okay, today's interest rates.
So we're gonna have, so there's a lot of talk going on right now in the real estate market. Everybody wants to know, is it a buyer's market, seller's market? Obviously, it's a huge change from what we've seen a year or 2 years ago. So Julie's going to talk about what are today's interest rates, what are they really looking like? And, possibly what can happen in the future, but disclosure, we're not fortune tellers, so this is just probably just based off our opinion. And then afterwards, we're gonna be opening for questions and open discussion.
Okay, so I want to start with rates are definitely higher than they were last year. But it doesn't mean that you have to. There are ways I can still get rates low. The rates for the fixed rates are in the 6 range. They did hit the 7 range, but the good news is that they went back into the 6 range. So a 30-year mortgage right now is actually just went down into the low 6 range. We have ways of getting rates right now into the 5, possibly even to the 4 range. And by doing that, we are seeing a very popular product. It's the 10-year ARM. It's a 10-year loan, it's 30-year loan. It's a 30-year amortization, but it's fixed for 10 years. And the average American keeps the mortgage for 5 to 7 years. So in the olden days, everyone just says, I want a 30-year fix, I want a 30-year fix. But they don't realize that there's this option out there that's fixed for 10 years, and then it starts to change years 11 through 30. So if the 30-year fix is in the 6 range, I could potentially get a 10-year ARM into the 5 range. And if it's interest only, I can get into the lower 5 range. And if it's in a certain product, and you move money over to the bank, I could potentially, in certain cases, get into the 4 range. So just to explain this product a little better, is you're fixed for 10 years. And you can refinance without penalty at any moment you want. And after the 10 years, you still are safe-ish because you will have some caps. The lifetime cap on this product is 5% above the start. So if you're in the 5 range, you'll never go higher than 10.5. And this will never happen until years 11 through 30. So it's an interesting product, and it depends on how long you plan on keeping your mortgage for. So some people will come to me and say, I'm buying a studio, and I know that in 3 years, there's no way I'll be living here. There's no reason for anyone to be in a 30-year fix if that's the case. Or I'm moving to the suburbs in 5 years, or a lot of people are talking about a potential refi wave within the next year. So if that's the case, what I see and what I've seen in the past 30 years is that my clients who insist on having 30-year fix, well, they come back to my office and they do a refinance. And so the statistics of somebody keeping this mortgage past 11 years or on the 11th year when it changes are very, very low. So it's just something to look at. There's another option that you have, which is buying down your interest rate. So let's say I'm buying this place, I'm going to live here, and I'm gonna die here, and there's no way there's gonna be a refi wave, and I want a 30-year fix, fine. So let's say your rate is 6.25. You could pay 1% at closing and buy your interest rate down. So 1%, so pretend like, just because it's easy for my mind, the loan is $1 million. And you pay 1%, so that's $10,000. And your rate of 6.25 could potentially be bought down to 5.875. So there are ways to bring rates down. And it's sort of it's a discussion that I will have with you as the buyer and say, you might come to me and say, I can only afford this monthly mortgage payment. How do we get there? And I'm going to think of ways creatively to get you down there, whether it's an ARM or whether it's maybe prepaying, a point, or maybe, moving money to Citizens Bank and getting a discount on your rate. And another option is something called an interest only, where it's harder to qualify for, so you have to have a little bit higher income, but you're only paying interest. You're not paying principal. This is made for special situations. If you own your own business and you take a tiny salary and every year in December your business explodes because you're in Christmas store business and that's where you make all your money, and you get huge amounts of income in December, then maybe this mortgage is good for you because your payments are small and then you can prepay your mortgage when you make a lot of money or when you come across that money every year. And then once you prepay your mortgage, your payments drop. So yeah, there's definitely ways, again, to get your rate into the 5s and the 4s at this time. And I say, this is my opinion, I feel like in the future, we're definitely going to have a rate decrease. Because I think statistically, what I've seen is when rates go flying up, they always seem to come down. And yes, they went up faster than I've ever seen them, but I do believe that they'll be coming back down and we'll have an opportunity to refinance.
Awesome. Thank you so much, Julie. That was amazing information. And now I'm just going to leave it to anyone. Does anybody have any questions or anything you guys want to discuss?
Presente, tú lo me lo traduces.
Okay.
Para que yo sepa.
Okay.
Yo no entendí bien quién paga el appraisal. Si es el comprador o el que vende.
So who pays the appraisal, she's asking?
The client, the buyer, you do as the buyer. Yes.
Tú como comprador, tú pagas el appraisal.
So,
You understand?
yo no aplico para un FHA.
Would she, could she be approved for an FHA loan as someone who's already a property owner?
FHA, I believe it's only for primary homes.
So if it was an investment.
If it's an investment, it couldn't go FHA.
What if she was buying it as another primary, like a secondary primary home? Could that work?
Good luck with that one. Nope.
No.
No. Sorry.
Okay.
If she has equity, if you have equity in your current primary home, I could look at getting a line of credit. A line of credit on a primary home to buy your investment property. The good thing about our line of credit at my bank right now, we pay the closing costs. So you would have no closing costs. And because we pay the closing costs, we're going to ask that you keep it open for 3 years. If you were to close it, you then pay your closing costs. And you can keep it at $0, so there's zero payment. So it's a nice deal. And that's just a totally separate program. But yes, that's the closing cost assistance program.
Yeah. Okay. Do you have a question?
Yes.
Okay.
And all this information that you just provided, does this apply to New Jersey? Like if I wanted to buy a house in Jersey?
Yes, most of it does. One of the programs we have, Sony Mays, is based for New York only.
Mm-hmm.
However, and the closing costs, New Jersey, you're very lucky because you won't have any of the tax. You don't have, I think you do have the mansion tax, but you won't have the state mortgage tax in New Jersey.
Does anybody else have any questions before we wrap up? Yes.
What are the 4 lines of credit?
What are the 4 lines of credit?
Oh, like what could they be? Credit cards, student loans, mortgage. If you don't have 4 lines, by the way, I can create credit. It's called alternative credit. So I would get 12 months canceled rent checks, maybe 12 months electric, water, cell phone, something that you pay every month, and that we can verify that you're paying every month.
I'm an Uber driver, so I'm self-employed. So how would that work?
Yeah, I would have to get your tax returns and analyze them. I would have to look at your net income, and we have a program now called Fact Check. So I would send your tax returns in to be underwritten, literally. And then I'd come back to you and say, this is the income we would use to do your debt divided by your income to figure out your DTI.
So that's what I wanna know, what do I have to get together as a self-employed? Cause that's literally that's been my income for the past 3 years and a half.
Okay, and do you pay yourself as a Schedule C or as a consultant or 1099?
I believe it's a 1099,
Okay,
yes. It is.
so you would need 2 years of your personal tax returns, 2 years of your 1099s, and then you'll send them to me, and then we'll talk about it.
Okay.
Any more questions? Comments? Anything? Gonna wrap up. All right, guys. So I just wanted to say thank you so much from the bottom of my heart for coming over. We do appreciate you. Again, my name is Chrisanji, licensed real estate agent here in New York City. This is Julie Title, and she did leave her information on the pamphlet. And if you guys need my contact personal information, you guys should have it. But if not, we can talk about that afterwards. Okay. So thank you so much, and it's a wrap.
Thank you.